So if you're new to commercial lending, it is a completely different world than residential lending. And I'm going to help you understand why there are differences in how the commercial lending market works. If you've ever been through the residential mortgage process, what you need to understand is a home mortgage loan is done by a bank and then typically sold into the secondary market. There's only a handful of residential products available, and you can secure a long-term 30-year fixed-rate mortgage because the majority of the home mortgage loans done in this country are backed by the federal government. So they get bought into the secondary market at a low interest rate that's fixed on a long-term basis because of that government guarantee. Now, when you're looking to do a commercial loan, the majority of commercial loans in this country are made by commercial banks. The biggest difference is that banks are lending their own deposits out versus selling the loans into the secondary market. So they need to charge you based on the cost of those deposits, what you're getting paid on CD rates, money market rates. Banks don't know what the cost of their deposits are going to be tomorrow. In theory, they do know, but they don't know what they're going to be 5, 7, 10, or 30 years from now. So because of that, most commercial banks only fix their rates for 5 and on occasion 7 or 10 years. And it's just because they don't know what the money that they're lending you is going to cost them long term. So the biggest difference you're going to see when you go to get a commercial loan is a much shorter fixed rate than you will see in the residential lending market. The other big difference that you're going to find is when you get a residential loan, residential lending's relatively uniform. There may be a little bit of some basic different criteria between banks and lenders on what they'll accept, but across the board, it is pretty uniform, especially in the secondary market. When it comes to commercial lending, all banks are different. They have different loan policies, they'll do different types of loans, they'll structure them different ways. So talking to one bank and two banks on the commercial side can be completely different, whereas on the residential side, really probably the only difference you're going to get in rate. On the commercial side, it could be the term, it could be the rate, it could be the amount of money they're willing to give you for the loan. There's a lot of different things that can change, and that's why there's a lot of variables when you're working with the different commercial lenders. One other difference is in the approval process. When you go to get a residential loan, the bank is primarily underwriting your personal financial condition. However, when you go to get a commercial loan, they are primarily underwriting the asset that you're buying, whether that's a piece of real estate or a business. So as an example, if you're buying an apartment building, the lender's going to primarily underwrite that apartment building. They're going to want to be sure that apartment building generates enough cash flow to support and pay the loan. Now, that doesn't mean they're going to ignore your personal financial condition. They're still going to look at your personal condition. They're going to want to be sure you have good credit, that you have outside income to support your own expenses. And the reason why they're doing that is they want to see how big of a risk you are personally on the loan, as well as to be sure you have the personal cash flow and income to support your expenses, and you don't need to drain the cash flow from the property you're buying to pay your expenses. But overall, a majority of underwriting's on the property. So there is a big advantage from that standpoint when you go to get a commercial loan. They're not going to judge everything that you have personally in getting that loan. The last thing that's different is there are a lot of different products for commercial real estate loans. Now today I'm going to specifically talk about loans for commercial investment properties, but you have different loans if you're going to buy a business or if you need working capital for your business. And then there's a whole other set of loans for owner-occupied commercial properties. But today we're going to focus on commercial investment properties. The primary loan is standard commercial bank mortgage, and typically it's what they call a balloon mortgage. And what this means is you get a 5-year fixed rate loan. Your payments are typically amortized over 25 years. And what I mean by amortized, it's like you're making your loan payments on a 25-year schedule. But your rate is typically only fixed for 5 years, on occasion 7 or 10, but 90% of the market is 5 years. And then at the end of the 5 years, your loan balloons. And what that means is the remaining principal due on your loan comes due. So at that time, you can renew it with your lender or refinance it with another lender. But at the end of that 5, 7, or 10-year fixed rate period, you will have to do something related to your loan. The second major product out there, which is about 10 to 20% of the market, is what they call an ARM mortgage. This is also done by a commercial bank. And under this scenario, you end up with a fixed rate for 5, 7, or 10 years again, but instead of having a 25-year amortization, you have a 25-year loan term. What happens at the end of the 5 to 7, 10-year fixed rate period is your rate automatically adjusts, and it may automatically adjust every year after 5 years, every 3 years after 5 years, or every 5 years after 5 years. It's all up to what you negotiate on the front end with the lender. And in most cases, it's going to adjust to a rate that's comparable to what the market interest rate is at that time. If your loan adjusts at the end of 5 years and you don't like your new rate, you can always refinance with your current bank or with another bank, but you don't have that automatic hard maturity at 5 years like you do with a balloon loan. And then the last option that's available is what we refer to as non-bank lenders. And when we say non-bank lenders, we're just referring to institutions that are not banks or credit unions. They may be publicly traded companies, they may be private equity firms that have lending divisions. Oftentimes, these companies can do things different than banks because they're not lending deposits like banks are. And there are options to get up to 30-year fixed rates on some of these products. The biggest challenge with these products, though, is that a lot of these lenders that offer 30-year fixed rates sell them into the secondary market. Very similar to what happens with residential mortgages, but these are commercial mortgages and they don't have a government guarantee like residential mortgages do. So because of that, they're deemed to be higher risk. So a 30-year fixed rate is likely to be 1 to 3% higher than a bank fixed rate is going to be for two reasons. One, it's a 30-year fixed rate versus a 5-year fixed rate. But secondly, because it's deemed higher risk when it's being sold into the market. But you do have the option to go ahead and get that 30-year fixed rate, but you just need to understand that it's a higher rate. Now, we find most of our borrowers prefer bank financing. The interest rates are cheaper, and because of that, they're looking to get the cheapest rate on the front end that they possibly can. Your average commercial loan gets refinanced typically every 5 to 7 years anyways. Not necessarily because they're forced to because of the interest rate change or a balloon, but a lot of times because borrowers are looking to make improvements, or they decide to sell the property, or they're trying to take cash out to buy more properties. There's a lot of reasons why people change their loan anyways. So unless you really plan to hold the property long term and you want to take the 30-year fixed rate and just put the loan on the shelf, the best thing you probably are going to want to do is get a standard commercial loan if you can qualify for it. Now, the only other thing I will say is that there are some of our non-bank lenders that will offer the 30-year fixed rate loan under a low documentation situation. And what I mean by that is they don't verify all your personal income. They really just purely underwrite the property and look at your credit score. So for people who may not have a lot of outside income or may not have a lot built up financially, it is a great option for them to buy an investment property, get a long-term fixed rate, and not have to go through as much underwriting personally. Again, the rate is higher for those types of products, but it is an option. If you'd like to learn more about the options for financing commercial real estate, owner-occupied commercial properties, business loans, or anything else, please just reach out to us. We look forward to working with you and helping you secure the best financing available in the market.